Good morning, everyone. My name's Iain Craig, BDO's Eye on Tax, for obvious reasons. Welcome to our Rethink webinar series, episode 14, about rethinking your tax. I'm joined today by Mark Lodder, my good friend from Christchurch.
Morning all.
I am an Auckland tax partner, and I'm here today with my webinar waistcoat, my COVID kilos, and my lockdown hair, which I would describe as, at best, windswept and interesting. And today we're going to go through a number of topics for you. Today we'll have a quick recap on COVID relief. This was a topic that came up at the last Rethink webinar, and so we were asked to recap on the COVID relief measures. Mark will then take you through some of the more interesting rules that we've been introduced for attacking the residential property market again. And finally, I will finish with rethinking trusts, having regard to the fact that we've got a new Trust Act and we have new information gathering proposals issued by Inland Revenue. Our intention is to leave plenty of time for Q&A. The usual rules apply. Please post your questions on the chat box, and we'll do our best to answer those questions at the time. So, firstly, on COVID-19 relief. Look, I think it's safe to say that the government moved very quickly back in March 2020 to bring around a whole lot of different forms of relief. And they're highlighted in this slide, from the small business cash flow loan, the low value asset write-off in the top left-hand corner, which initially went up to $5,000, and I jokingly said that was about the price of setting up your home office. That has dropped back down to $1,000 as was originally announced. Building depreciation came back, and there's a whole lot of relaxation about filing deadlines, waiving of penalties, use of money, interest, etc. Two of the key issues that came out from a tax perspective was the temporary loss carryback. And this is where if you incurred a tax loss in the 2020 or the 2021 income year, you were allowed to carry that back 12 months to the previous year. And if you paid tax in that year, it generated a refund. Many of us hoped that that would be more than just a temporary measure and that it would be made a permanent feature of the Tax Act. Unfortunately, that doesn't seem to be on the agenda for Inland Revenue or Treasury. I think it costs them a bit too much. So that is just a temporary relief and is not going to continue at present. They also announced that they were going to introduce the same business test for loss carry forwards, and this is a permanent feature. And this is where that a tax loss may be carried forward even though you have a shareholder change, if you satisfy what they call the business continuity test. And we'll go through that in a little bit more detail. As we transition from level 4s and level 3s, and God knows in Auckland is it level 3.2, 7.5 or something like that, who knows. We are about to move into the traffic light transition system, and at the moment, back in October, the government announced changes to another resurgence support payment, where they've increased that to $3,000 for full-time employees and $800 for part-time employees. They've changed it from a 3-weekly payment to a fortnightly payment, and this last resurgent payment applies from the 12th of November. So the estimated cost of that is round about $940 million per fortnight. And I had a look on the IRD website yesterday, and there's been at least, I think it's 5 resurgence support payments that are categories that have been available to be applied for. And those applications are still open through until 1 December 2021. And I was talking to a small business owner last night who indicated that she hadn't applied for the resurgence support payment because she benefited from the wage subsidy and the small business cash flow loan and thought that was enough. And but they are struggling to survive, and so they're revisiting that resurgence support payment. So watch that deadline. If you haven't applied, it's 1 December. Have a look on the IRD website and make your application. The wage subsidies are continuing through when any part of the country is at level 3 and to red. You can expect that the wage subsidy might transition down to when we go to an orange or a green traffic light. And I think I was expecting that we might get a government announcement about how they were going to transition that before we had this webinar, but that hasn't been released as yet. The last part of the package that was announced in October was the $60 million aid for Auckland. And that is split into two elements. There's 50 million that's been allowed for business advisory support, which is being provided through the Regional Business Partner Programme, of which BDO is one of those partners. And it allows you to get some advice for your business at up to $3,000 in fees for professional advice, and then allowed a $4,000 for implementing that advice if you, as your business reopens, you need to seek that advice. The latter part, then there's 10 million that's been allocated to the mental health and wellbeing support. And that is a programme that's been currently designed by the Employers Manufacturers Association and the Auckland Chamber of Commerce. Again, I had a look last night to see if there was any detail on that, and I wasn't able to find anything, but there 10 million has been allocated for that, but it is part of that October business transition support. So they seem to be the three main elements of support that are currently applied. Last webinar, we talked about, the question came up about what can I do with, I've made some losses, what can I do with it? So the business continuity test was one of the major initiatives that I mentioned before. And the bottom line here is if you've had losses since 2013 to 2014 through to 2021, but you hadn't had a shareholder continuity breach, then if you go out and attract a new investor into your business, into your company, and suffer a 49% continuity breach, that you will still be able to carry forward those tax losses beyond 2020-21, provided there's been no major change to your business, i.e. the same business continues. Now the good news is that they recognise that a same business, they don't want to limit your business from adapting and changing to the market. So they have carve-outs that are called permitted changes. So if you have a major change in your business, if it's attributable to the desire to drive out efficiency, to take advantage of technology, to increase your scale by going to a new market, or develop a new product or services, that's all good. And those sort of changes are not enough to breach the business continuity test. Now, the Inland Revenue published a lot of examples, which are useful illustrations as to what that might mean. And I think you can refer to those examples, and they will be looking at the assets that are there, the assets that are employed in the business. Now, what the Inland Revenue don't want is for this business continuity test to result in a whole lot of trading in tax loss companies. And that comes up in three areas. They don't want dormant companies to suddenly be sold and the losses that are trapped in those dormant companies to be utilised under a business continuity test. So if you have a dormant company and it hasn't been revived, the business has ceased, then you're in danger of falling foul of that provision. The second area is if you've deliberately changed the business. So you have a major change in business, which would otherwise have been a breach in the business continuity test, but you do it in some way that happens 2 years before a 49% breach in continuity. then you will fall foul of this provision. So I could imagine an example where a new investor comes in, they lend money rather than buying shares. They deliberately change a major change in the business 2 years out, and then after before, sometime within the 2 years, they convert that loan to equity to breach the shareholder continuity. That might be one that would have to look at. Now, the real question is, if that structure is set up that way, it was the purpose of that arrangement to defeat the intent and application of the business loss continuity. And the last one is an anti-injection rule. Now, this is where you've got two associated persons. One person is deriving income, the other person has got losses, and there's a deliberate diversion of that income into the lost company. So you need to be careful at looking at all of those three. So what does this mean for you? Well, it means that if you're a lost company and you can attract new investors because you're hungry for capital to restore the balance sheet after this COVID period, then you can attract those investors without fear of losing the losses. And I think as long as you're not in that sort of dormant lost company or falling foul of an arrangement or a anti-injection rule, then you can be reasonably comfortable that those permitted carve-outs will provide a business continuity test. I guess the open question is, if you're a new investor, what would the new investor value those losses at? And can you put a dollar sign on that to generate some more tax, a consideration for the shares for you? And that will be horses for courses and an interesting valuation question. So they're the recap. That's the recap in the COVID relief, and I'm now going to hand over to Mark to go through the new property rules.
Iain, I think you've opened the door, and I'm going to walk through it. But I have to say, Iain, the interaction of your hair and the backdrop behind is wonderful. It's got a life of its own. Appreciate I can't talk at the moment because I'm waiting to get my hair cut for Christmas. So, and in solidarity of Iain, I'm holding off as well. So, right, new property rules for new tax rules for property, residential property. Here we go. Okay, let's start with the bright line period. Actually, no, we won't start with that. I'm going to start with, I think I've just got to highlight that we can't pick up everything. We've got a supplementary order paper at the moment that's still in bill form, which the commentary is well over 100 pages. It's yeah, there is an awful lot to it. So we've got a lot of new definitions. We've got what they refer to as the DRP. And when I first saw that, I thought that was perhaps a rapper, maybe mates with Snoop Dogg, but no, it isn't. DRP stands for disallowed residential property. No street credibility there. We've got apportionment all over the place. We've got different answers depending on when you bought property. We've got various exclusions for fairness. We've got what we call a B2.3.1 modification, which I'll get into. It's not an airplane, it's something else. We have transitional rules, anti-avoidance, and we have legislation, as we know, that went through very, very quickly to catch us all out with respect to the new bright line periods. So if we start with that snapshot, bright line. So the bright line was introduced as a buttress or to supplement the existing legislation that says if you buy property with the purpose or intent of selling it, then we're going to tax you when you sell it. Very, very hard for the commissioner to prove other than via circumstantial evidence. I mean, many times have I said to Iain, did you buy that with the intention or purpose of resale? And on each and every occasion, Iain has said, no, I didn't. It's a hard one to prove. So this bright line brought in some subjectivity. Removed the subjectivity and brought in the objectivity. So prior to the 1st of October 2015, we don't have a bright line. if you have acquired residential property between the periods 1st of October 15, 28 March, 2 years, 29 March to 2018 and 26 March to 2021, we have a 5-year test. 27th of March and 21 and later, it's a 10-year test. So if you sell property, residential property within those timeframes, and you don't meet any of the exclusions, such as the main home exclusion, then it's very objective. It doesn't care about the reason for sale. It doesn't matter if you've fallen on hard times. If it's in and you sold it within the timeframes, the bright line period, it's taxable. We do have this concept of a new build, which we'll cover off later, which introduces or reintroduces or keeps a 5-year test current for new builds. When we are looking at the relevant dates for a bright line, the first relevant date is the date that you acquired the land. That's going to set the time frame. Are you pre-bright line, i.e. before October 15? Are you a 2-year test, a 5-year test, or a 10-year test? The agreement to acquire the land is the really important date in this regard. So an agreement to acquire land is basically a contract to acquire land. It can be conditional. So it may have a finance or other clauses, exclusions or conditions such as finance and insurance, but that doesn't change the date that you've acquired the land for the purposes of setting which bright line period you're working within. But then the next question arises is, when does the clock actually start ticking? And this is where we get an awful lot of questions, and there is an awful lot of confusion, because a lot of the time you're going to say, well, I acquired the land at this date, i.e. the 1st of March 2018, therefore my 5 years is going to, or my 2 years is going to run from that date. That's actually not quite right in terms of the general position. The general position is that settlement drives the date, the time the clock starts ticking. So the example we have below, we've acquired land on the 1st of March 18. We didn't settle until the 1st of April 18. We sold on the 20th of March 2020. So we're looking at that at first blush, 1st of March to 20th of March. That's outside of 2 years. We should be good. We're not, because we didn't settle until the 1st of April. So we've actually got only a couple more weeks to wait before our bright line period ends. Definitely an area that we see over and over again, and it definitely causes an awful lot of confusion. So some of the practical issues we're seeing at the moment in terms of bright line. One is nominations. Now, let's say I'll use Iain again. Iain's bought some property, and he decides he's going to nominate me to settle, buy the property, own the property. From a bright line perspective, we've actually got 2 acquisition dates. So we have a date where Iain has acquired the property, but when he nominates me, I'm also deemed to have acquired the property at that nomination date for the purposes of bright line. So again, you've got to be really careful. If we think in the context of our new 10-year rule, let's say Iain purchased on the 26th of March 2021 and nominated me on the 28th of March 2021, I'm under a 10-year rule, because the date of acquisition is the 28th of March 21. We have to be really careful with nominations, because it can reset or change a bright line period. We have off the plan acquisitions. Actually, we'll go with application of the main home exclusion. So the main home exclusion is for property acquired prior to the 27th of March. At present is an all or nothing test. So if you have the main home exclusion, you have tax relief on the whole. There's no apportionment, nothing else to worry about. So if we take the example, Iain bought some bare land. and he bought it on, I don't know, the 1st of March 2018 again, and then he built a property. But the property took a year to build, and he then decides to live in the property. So it's a year to build. He's not living on it until 2nd of March 2019. He then lives in it for 6 months and decides, oh, this is actually too small for me. I'm going to sell it. But that's all right, because it's my main home. In terms of the main home exclusion, what we've got to look at is we've got to look at the length of time, the proportionate length of time that he actually lived in the property. And based on that example, he's actually not over 50% occupancy. So he's owned it for maybe just under 2 years, but he hasn't lived in it for over 50% of the time of ownership. So under current settings, he wouldn't be able to apply the main home exclusion and subject to tax on the way out. It's a similar issue with off the plan acquisitions. It's just that one of the practical issues that we do see with an off the plan acquisition, and in terms, it's not really an issue, it can also be a benefit in terms of timeframes. But for an off the plan acquisition, the date from which the bright line clock starts ticking is altered. So rather than settlement, it's actually at the date we acquired the land. So when we entered into that agreement, that's the date that we start running the clock, not settlement for an off the plan acquisition. Short stay accommodation, Airbnb, a topic that creates an awful lot of excitement, not just for this, but also for GST. But short stay accommodation, we are effectively running, you can run a couple of different arguments depending on acquisition. So for property acquired, residential property that's going to be used as short stay accommodation prior to the 27th of March 2021, you got an argument. Does it meet the definition of business premises? The definition of business premises for that period, i.e. prior to the 27th of March, gives you a bit of wriggle room to argue that short stay accommodation would not be subject to bright line because it's business premises. And Inland Revenue acknowledges this, that there is some confusion or there is some ambiguity. You can argue both ways. From the 27th of March onwards, 2021, the definition of business premises has changed and specifically excludes your short stay accommodation. So on a go forward basis, your Airbnbs, other than perhaps those that are occupied by the owner as well, would not qualify for the business premises exclusion to remove or mitigate the effects of bright line. The other one, which can be particularly nasty, are your hobby farms. So as we talked about before, the main home exclusion looks at, say, a 50% test. So if you can imagine a hobby farm, maybe 10 hectares of land, there's as a good taxpayer or GST registered person, you've made a dwelling and curtilage adjustment for the 4,500 square meters that you've used for your main home or whatever size it is. So if we look at the land as a whole, only a small part of it is being used as the main home. The area used for the main home isn't sufficient to meet, say, a 50% test. We're only occupying parts of the land. But then you go, that's okay. So if I can't get the main home exclusion, should I be subject to bright line on sale? Then it's a farm. I'll go for the business premises exclusion. But with hobby farms, you've got to be very, very careful with that business premises exclusion, because in order to meet the business premises exclusion, you need to make sure that it's of such a size and land capable as being farmed as a business. And more often than not, that hobby type farm scenario would not meet the business premises exclusion either. Therefore, you're stuck in no man's land, whereby you can't meet the main home exclusion, and you don't meet the business premises exclusion. Bad luck, really. That's just the way the rules work, unfortunately. But it's definitely an issue we see. It might well be sensible to look at perhaps subdividing the land such that the main home is on its discrete particular parcel, and then at least you get the main home exclusion, because that whole title in isolation is being used as a main home. Okay, interest deductibility. This is the one that really has, notwithstanding Bright Line is an absolute capital gains tax by stealth, given we're now in a 10-year time frame. Interest deductibility has caused a great deal of upset in the tax community. I think Iain said the other day he was offended, mortally offended, by the interest deductibility rules. So for acquisitions of residential property meeting the definition of disallowed residential property, this is our DRP mates with Snoop Dogg, you can't claim interest on acquisitions of DRP subject to whether or not there's any exclusions or exemptions on or after the 27th of March 2021. So there are exclusions, there are exemptions, exclusions relating to new build, employee accommodation, hospitals, so on and so forth. But fundamentally, your residential property used for investment purposes, you're not going to be able to get an interest deduction for your borrowings on or after the 27th of March 2021. For property owned pre-27th of March 2021, we have a transitional phased out deductions that we can apply. So for interest earned between the 1st of April 21, 31st of March 2022, we've got a dual period. The percentage, we've looked at it percentage denied, but I'll talk about it as in terms of 100%. For your interest incurred between the 1st of April 21 and 1st of October 21, you can still claim all of your interest deductions. From the 1st of October to 31st of March, you lose 25%, you're claiming 75%. Each subsequent tax year, you're dropping down another 25% until from the 1st of April onwards, there are no deductions for interest on DRP that doesn't meet one of the exclusions or exceptions. It's phased out to obviously help the taxpayer, get them used to this, maybe change their affairs, work things out. Hence, we've got this additional complication, all in the for the benefit of the taxpayer and in the interests of fairness. We're certainly not going to complain about it because we'd rather have this than nothing. But it does mean there is a little bit more complexity in making sure that you don't overclaim your interest deductions. Okay, new builds. It's the way I'm reading the supplementary order paper. The definition of a new build isn't necessarily as complicated as it could have been, but new builds certainly have relevance to Bright Line timeframe and to interest deductibility. It's clearly concessionary treatment. The big thing with new builds, though, it's also an absolute classic case of using the tax system to bias and distort behaviour to encourage taxpayers to build new property, increase the supply, and hopefully deal with the wider problem faced by New Zealand, that the cost of residential property is really, really high, and this is one of the ways that they're seeking to fix it. by 1, denying the deduction of interest for the pre-27 March, subject to transitional phase out, and introducing a new build concept, which is concessionary for the taxpayer. So if we look at it with reference to the bright line timeframe, the bright line timeframe for new builds acquired on or after it's the 27th of March 2020. So 27th of March 2020, not 21. The bright line timeframe isn't 10 years, it's back down to 5 years. Now, the definition of a new build for the bright line purposes is far narrower for the purposes of interest deductibility and disallowed residential property. So we've got more complexity in here in that we are referring to new builds differently depending on which thing you're looking at. Are you looking at bright line or are you looking at interest deductibility? So in terms of the bright line time frame and 5 years, we're basically looking at, has a code compliance certificate been issued within 12 months of acquisition? If so, then it's a new build. With interest deductibility, it's definitely slightly different. It is made with reference to code compliance certificate, but interest deductibility or new build, the definition of a new build can span 20 years or will span 20 years. So it doesn't matter if you're the original owner of the new build or you're the 3rd, 4th, 5th, 6th owner of this new build. It will be a new build for 20 years following the issue of the code compliance certificate, which does mean if you are looking to invest in new builds, you're going to need this information to make sure you're working within the right timeframes and maintaining your interest deductibility under the new build legislation. There is anti-avoidance legislation, which I think might be on the next slide. Yeah, it is. So anti-avoidance legislation is in place for those that may seek to delay the issue of the code compliance certificate. And fundamentally, the rules are going to be modified or are modified such that your time frame or your 20 years starts ticking from the date the build has been substantially completed. This is where your B2.3.1 modification comes in, where more often than not, where a CCC can't be issued, they do issue a CCC subject to a B2.3.1 modification, and that's often where there's a delay of more than 5 years for a code compliance certificate. So this is one of those areas where your clock would start ticking sooner than what you would ordinarily expect under the general principle of issue of CCC. So definition of a new build we see as being a foreseen practical issue, which dovetails into perhaps new and old on the same title. But in terms of a new build, we're fundamentally looking at something which increases the housing supply. So there's a few examples in the supplementary order paper which talks about conversions of office blocks, and in particular a few examples regarding conversions of or the building of a sleep out. So a sleep out, which is just a sleep out on its own, a room, literally a room with a bed in it, would not meet the definition of a new build because it's not a self-contained unit. The person who's in the sleep out still needs a kitchen and still needs a bathroom, and they might have to go to the main dwelling to do their business in that regard. But if the sleep out has a kitchen and a bathroom, then suddenly it becomes a new build, which means perhaps you have new and old on the same title. If you have new and old on the same title, we do have that wonderful phrase in tax which refers to the extent. To the extent means we can apportion. So in terms of our interest deductibility, we are able to deduct interest for that portion which is new build, and perhaps we can trace that loan and quarantine it away from the old. Similarly for rollover relief. So remembering timeframes, practical issue, we've got all sorts of timeframes working. We've got our 2 years, 5 years, 10 years, 20 years. It can start from the 27th of March 2020, 27th of March 21, so on and so forth. It starts to get very, very complicated. Got to really, really remember your timeframes. One of the areas is tracing. So fundamentally, for all loans on drawn down on the 27th of March 20, or on or before 27th of March 21, we need to make sure that we are able to still claim deductions in respect of those loans, so that we're not disadvantaging the taxpayer. We also need to be really careful where we have perhaps both disallowed residential property and allowed residential property, so an allowed property which might include commercial property. How much of the loan can we apply to the allowed property, i.e. the commercial, as opposed to what wouldn't be allowed if it was disallowed residential property? The good news here is that when we are working this through, the preferences, or the underlying presumption is borrowing is first applied to good property, i.e. property that would be allowed ordinarily an interest deduction for, i.e. a commercial. So tracing, another area of complication. We've also fielded a few questions around interaction with mixed use asset rules. So the mixed use asset rules are there to start denying deductions based on private use. How does that dovetail into transitional interest deductions? It does. You just apply 2 different percentages. So you work out what you would be able to deduct under the mixed use asset rules, and then you apply the apportionment or the transitional phased out percentage based on the 100, 75, 50, 25%, zero position. So all up, I just remember when the issues paper first came out, and we had a whole heap of information on. This is all about trying to make sure that we have uncomplicated law and introduce fairness, etc. This is not uncomplicated law. There are many moving parts. My head hurts just talking about it, let alone sitting down and actually doing it. There's going to be a few teething things coming through. We will work through them all. We will get there. But let's not kid ourselves. It is complicated, and in part because of the driver, we do need the complication. Otherwise, we're going to have a whole heap of complication and unfairness as well. So we do need these extras. I think this one as well, this proposed legislation for main home exclusion is going to be very, very relevant. Again, we just touched on our pre-27 March 21 position. It was an all or nothing test. So as long as you met or exceeded your 50% threshold, you would be able to rely on the whole of the main home exclusion. So you're either going to pay tax on everything, or you're not going to pay tax on anything at all. So all or nothing test. However, from the 27th of March and 21 and following, we're now moving to an apportionment. So it's going to recognise the time the property was not occupied as a main home. There are some carve-outs where perhaps your first or your last year is deemed occupation, which should solve some of those issues where you buy bare land and subsequently build on it. But fundamentally, we are moving to an apportionment model, but we still need to record what date we acquired the main home, because we do have two different rules working in tandem based on date of ownership. Okay, I think this was the one that we were quite excited about, and I'm only going to talk about it in terms of bright line, really. But we do have a bit of rollover relief. So the big problem at the moment is where mum and dad are looking to help son or daughter into a property. In fact, I'll get to that in a second. We've got some rollover relief. So, for example, let's say you've got mum and dad own a property. It's an investment. It would be subject to bright line if they sold it. They've received some advice. Family trust is the best way to go. We want to transfer the property into a family trust. Under current policy settings, that would be a disposal for the purposes of the bright line, and the transfer by mum and dad into the family trust could be subject to tax under bright line, depending on the timeframes owned, etc. What's more, the family trust would have a new date, or would reset the bright line period and bring it back, or potentially put it into a 10-year rule. This rollover relief proposes to, providing we meet certain criteria, proposes to allow mum and dad to sell the property into a family trust. And from a bright line perspective, the family trust merely stands in the shoes of mum and dad. It's a similar issue with LTCs and partnerships, provided we maintain the same level of proportionate ownership, i.e. we can't just transfer it to a single person when you've got many owners of the LTC. Importantly, with the LTC partnership one, it works both ways. You can transfer from LTC partnership to individual or people, and you can also transfer from people to LTC partnership. It works both ways, the relief. From the family trust perspective, it doesn't. It's only where you've got the individual transferring to the family trust. There are various criteria you need to meet in terms of principal settler and making sure that the beneficiaries of the family trust are related within 4 degrees of blood relationship to the principal settler, etc. But it's there. The only thing from our perspective is it's just not enough. It's not. When we were proposing on this, we wanted a lot more than this. We are at the moment, we've got a whole heap of inequity in the tax system where mum and dad are seeking to help son or daughter. So mum and dad buy a property and hold on to it until son and daughter are ready and are able to borrow. They sell it to son and daughter for cost. Happy days, we're all good, we looked after our own. Unfortunately, from a tax perspective, the bright line's going to get them because it wasn't the main home of mum and dad. So if it's not the main home of mum and dad, and if they sold it within the bright line period, then suddenly we've got a disposal for tax purposes which directs us to use market value. So we are then interposing market value over cost, and mum and dad have a tax liability when all they wanted to do was help out son, daughter, until they had a point where they were able to get on their feet. There are ways of looking at this, but you've got to be very, very careful in how you set up your legal form. So if mum and dad acquired property as bare trustee or nominee for son or daughter, then we have a bit of wriggle room, because the Income Tax Act recognises that bare trust relationships are effectively ignored, and we look to the beneficial owner. So provided we do have a bare trust or nominee, son or daughter are always deemed to have owned the property, and there is no transfer other than the legal transfer from bare trustee to son and daughter. From a tax perspective, we don't have a bright line problem, but you do have to be very, very careful that you do in fact actually have a bare trust, and that there are things in place that support and substantiate the bare trust, such as perhaps a loan between mum and dad to son and daughter, and that is documented such that son and daughter have some economic cost or obligation as well. So we have this rollover relief. It helps in part where we have some form of family restructuring, but it is a very, very limited relief and really does not go far enough. So with that, I think over to you, Iain.
Yeah, thanks, Mark. A very, as you say, complicated and detailed topic, and we knew that you'd be tight on time. Just to all the attendees, we're happy to run over 5 or 10 minutes if we haven't got through to all the questions. So just don't feel you have to leave at 10 o'clock, but we'll do our best to get through them through the rest of the presentation. So I wanted to talk about on the trust is that the trust is dead. Long live the trust. I think it's be safe to say that there's a feeling you could think that the trusts are under attack. We've had a new Trusts Act 2019, the first major law reform in 70 years on trusts, and I think the Trusts Act, some of it is pretty good. It's embodying what was established out of case law into the Trust Act itself. And although it was introduced in 2019, it didn't take a full effect until 31 January 2021. So the new Trust Act is what applies. And most of you will have heard that one of the implications of this for your trust is that you must provide basic trust information to beneficiaries, and that must be disclosed in a regular intervals. Doesn't say what regular intervals would be, but you need to tell them that they are a beneficiary, and that's all you really need to do. You can tell them that they're a beneficiary and that they are maybe likely to obtain some benefit from it, or they may not. But the beneficiary also gets the right to ask for some trust information, such as financial statements, or and ask for how the decisions are made, etc. So there are also other changes in the Trusts Act which I think are quite important. And if you haven't reviewed your trusts in accordance with the Trusts Act 2019, you should definitely do that. In addition to the new Trusts Act, we have Inland Revenue, we had some law that was passed in December 2020, which now requires certain trusts to file financial statements with their tax return. And that has already been passed. And last month, Inland Revenue issued a discussion document around what other information they would like to collect in relation to trusts. This would include, under the proposals, include all the personal information of all settlors, trustees and appointers, and that would be that would include their date of birth, place of tax residence, etc. They are looking to collect details of all the distributions that are made by the trust, the value, the date, the details, and the details of who it's being provided to. And that is going to come out in a prescribed form of disclosure that hasn't yet been released yet because it's still a discussion document. And we will wait to see what that will look like. But it's going to add to extra costs to comply with Inland Revenue's requirement. Now, there is, if you're a non-active trust with just owning a family home, you can apply and get out of that requirement to some of that disclosure. There's also a de minimis threshold, which reduces some of the information that needs to be disclosed, and that's if there's a revenue or expenditure less than 30,000 Kiwis and an asset of less than $2 million in a trust. So It's a pretty low threshold if you think of some trust holding a beach property and a house in Auckland, for example. The asset base would be quite high, and revenue or expenditure would depend on whether that was assessable or deductible, etc. So these proposals, I think, are interesting, and again, it's just another reason why you should be reviewing your trusts. There are some traps with the information that they're looking to require, and I think there are some challenges around this. And it's really around some of the areas like non-cash settlements and non-cash distributions. In our Tax Act, a settlement on the trust can often include things like interest-free loans or forgiveness of loans, etc. There are a number of, the definition of a settlement is quite wide, but it doesn't always mean the $100 that you first put in to get the trust set up. And you need to identify and value all of those non-cash settlements and disclose it to the revenue under the current proposals. It's a similar thing with non-cash distributions. Is there a benefit provided to beneficiaries out of rent-free accommodation or interest-free loans? And if that's a distribution that needs to be disclosed, then that's going to be quite a mission to try and identify and value and disclose all of those distributions. Can you imagine, and I'm not sure of the answer on this yet, I need to dig a bit deeper, but can you imagine if you've got one of those rolling flexi loans with the bank over your house, and you're in the disclosure regime because you've got other investments in the trust, and you draw down and pay for various bills, etc. On drawing in and out of that flexi loan, could that be a problem that you create a non-cash distribution? Finally, there's some things around capital distributions where Inland Revenue are going to get a lot more visibility on regular and recurrent distributions. So if you're drawing down funds out of a trust and arguing that it's not income, but it's a capital distribution, then there is concern has been expressed by some advisors that might look like regular income to a beneficiary and seek it to be taxed. So I think there's some traps in this information gathering that they're looking to get. I think it's going to increase the compliance cost, but I don't think it's necessarily a bad thing, because I think the trusts need to be run properly. They need to be get appropriate financial statements so that you can exercise your trustee duties properly. But I do have to wonder, why does the revenue need this information? Other than sort of maybe putting the trust on a par with a company disclosure, I'm not sure what they're really trying to achieve from it. But we've had a number of clients go through a trust review, which they have decided that the old trust deed is no longer fit for purpose, and they will, rather than get rid of the trust altogether, they will resettle it into a new trust, which has a trust deed that has been properly taken into account the new Trust Act. And when you go through that resettlement, there are tax consequences which you need to go through, and these are some of a list of those that you need to think about. I think the one that I think is interesting, and one that BDO has submitted on, is that a resettlement of the trust, even though it's effectively in the same ownership, same trustees, and really the core beneficiaries will be the same beneficiaries as the other trust, that will be enough to trigger a new acquisition date for the bright line period. So you might well, and if you don't take advice and don't work through this, you might find that you've transferred a property that was not subject to 5-year or 10-year, but you suddenly get into that 10-year bright line period by accident. So hopefully we might see some movement in that respect. So I think rather than sort of recap, we've obviously gone through quite a lot of issues in the last presentation. There was a lot to cover, and I'd like to move on to those questions and answers. Mark, have you got a question that you want to deal with?
Yeah, there's a few coming. I'm looking to my right, everyone, because it's on the screen to my right, so you know. One question: if you've acquired an apartment prior to the 27th of March 21 used for short stay accommodation, is the interest on the loan deductible because the apartment is being used as business premises? This is a classic case of where it gets so confusing. So we talked about the business premises exclusion and your 27 March pre-post. That's with reference to the bright line period, not with reference to disallowed residential property. So we've got bright line versus interest deductibility. So in terms of the bright line, you might have a different outcome, but with respect to interest deductibility, I think it would be subject to the transitional phase out rules. Yeah, and one where it gets very confusing. We've got, oops, what's happened there? There we go. Sorry guys, technical issue. We've got another question about nominations off the plan acquisitions. So we've purchased off the plan during a 2-year bright line. Then you've got the purchaser nominates an associated trust later. The trust then on sales to an external party prior to settlement, and nomination, on sale and nomination are a week apart. There's a year gap in time frame before it settles. Basically the question is, do we get a deduction in working out our income tax liability based on the original purchase price, or the value at the time of nomination, i.e. a market value uplift? I can't see a market value uplift in this situation, unfortunately. I see where they're coming from, but I don't think there's an ability to get an additional deduction there. Does the new build exclusion timeframe for interest deductibility only apply to properties where CCC is issued after the 27th of March 2021, or would, say, a property completed on Jan 2020 still be considered a new build? Unfortunately, no, it wouldn't be a new build. The new build rules do give a year buffer from the 27th of March 21, but it's only from the 27th of March 2020, so we're just outside. We have...
I've got a couple of questions on, which I give you a chance to get a break. I say we're happy to go for another 5 or 10 minutes to do this. So one of the questions was, does the same business test or business continuity test for losses, does that replace the shareholder continuity rules, or is that an additional test? And so what that is, it is an additional test, so that it only applies if you've had a shareholder breach in continuity of 49% after 2020-2021, after 2020-21 income year. So you only need to go into the business continuity test if you've had a breach in the shareholder continuity requirement for carrying forward losses, and that remains the primary test. And the second question was, have we heard anything about the government extending the interest-free payback date on the small business cash flow loan? And you know, the small business cash flow loan, you get a 2-year interest-free period, and then interest was charged for 3% after that, and you had 5 years to pay off the loan at that low interest rate. So I haven't heard anything about that extension. I think the point is made is quite a good one, because if you're only applying for it now, it will, because there's I think you still get your 2 years after that, but I don't think they're going to extend that interest period beyond that. And I've just checked with IRD's website, and there's no information up in relation to that extension at this stage. I do think we will see some more announcements on what the change to the COVID-19 protection framework will be and what it will mean to some of that COVID relief provisions. So watch this space. And we've got a very good COVID page on our website, which we would cover off in that area. So back to you, Mark. You're on mute.
Always helps to unmute, doesn't it?
Yeah.
I love that. This is a really good question. Is there bright line rollover relief for transferring a property from the family trust to an LTC? The trust would be the sole shareholder of the LTC. So I'd like to meet the genius that thought of this one. It's a really good technical question, because if you back step here, LTCs, look through companies, they're effectively ignored for tax purposes. They're deemed to be transparent. So therefore, a transfer from the family trust to the LTC is almost a boomerang back to the family trust, because you ignore the LTC. So you go, oh yeah, that should be all right. However, we've got rollover relief, which refers to LTCs. So in the context of this, an LTC is effectively deemed to, I would say, to be transparent. And no, I don't think there would be rollover relief in this regard, but there blooming well should be, is the answer to that one. For bright line,
Mark, I think the interesting thing would be as well, does it set a new acquisition date for the bright line? Because the rollover relief is only that the gain's not taxable, but you get into a new acquisition date, which then puts you firmly in, say, the 10-year bright line period, rather than if you were currently in 5 years or 2 years.
Agree. Yeah, definitely. And then the other one we've got, for bright line purposes, is the start date of the acquisition of land rather than the date of completion of the building. So I guess that depends on whether or not you're buying. Are you buying land which is unencumbered, doesn't have a building on it, or are you buying land off the plan and they're yet to issue title? So if you're buying land, and if you're buying land, a separate title, then we are looking to the start date for acquisition is going to be the date you entered into that conditional contract. Actually, it's the same for both. So I'm thinking the actual time frame. So the completion of the building is largely irrelevant unless we're looking for a code compliance certificate as a new build, and we're within that 1 year time frame. But for the bright line, and this is where it does get horribly confusing, bright line is different to disallowed residential property. One is referring to that, are we going to tax the property on the way out, and the other is referring to whether or not we can get interest deductions on holding the property. And they do have different connotations depending on what we're doing. But we always look at the date of acquisition being the date of the date of contract. Have you got any more, Iain?
There's one just come in just now, which I haven't had a chance to look at. Maybe you have a look at it. I think one of the one I think about the bright line period, and I think this is the easiest way to think of it, is that the start date starts at the latest possible date of ownership. So the completion date, and the sale date, when you decide when the property's been sold, starts at the earliest potential date for sale, so that there's obviously no incentive or ability to suddenly defer settlement of the sale process outside of the bright line period. And this is where I think, the 2 year rule was a reasonable rule, because the intention there was to eliminate disputes with inland revenue. 5 years you could probably live with, but the 10-year rule is really just, it's a bad capital gains tax, because if you potentially could be taxed at a 39% tax rate if it's held in your own name and you're a high income earner. Most capital gains taxes around the world are at much lower tax rates than the sort of top marginal tax rate. So that would be one comment. I don't know, Mark, if you had a chance to look at that last question.
Yeah, one of the questions was around when do we expect the bill to be enacted and the rules to become live. We're thinking March. We're hearing March, so Q1 of next year, and clearly retrospective application 1 October seems to be a common date for when all these things are kicking in. And thank you, Barb. That was your question on the LTCs. Oh, and then there's another quick question on the CCC being issued. I think it's 12 months of completing new build or whatever it is. There are some wriggle rooms for property that you've bought the land, then you build. So I'm talking about where you've got a subsequent transfer. If you've bought a new build, it's a new build as long as you're within that 12 months. For the purposes of rollover relief, i.e. for the purposes of bright line, I'm confusing myself, versus disallowed residential property, which is your 20-year rule. But I think that's pretty much. If there are any other questions, people can easily they can just fire them through. We'll find them. We're very happy to come back to you. Iain, is there anything else from your side?
No, I just thank you everyone for attending and staying on the line past the normal time. It was a big topic to try and cover, and we will no doubt have another session in the new year once the legislation has been passed, which is, I imagine, February, March next year. This is the last Rethink webinar for the year, but we will be back again in the new year with a series of webinars, and Mark and I will certainly do a tax one before the budget in May, and then one later in the year. So please stay in touch. I'd like to thank the backroom team of Christina and Jamie for their support in putting the webinar together. And thank you, Mark, for your taking on the big topic of the new proposed changes to tax rules on property. So watch the space, everybody, and I hope you all are allowed to travel. Stay safe, stay out of COVID, and enjoy a Christmas break that we all need after a very trying year. So good luck. If there's anything we can do to help, get in touch with your BDO advisor or contact Mark and I at the email addresses attached or through the website. Many thanks. Have a great day.
Happy holidays. See you, King.
Thank you.